And today's episode of Joe Knows Retirement, we're talking about one of my favorite topics, which is taxes. Now, I don't love paying taxes, but I love planning for taxes and more importantly, saving on taxes. And we're going to be talking about those specifically who have a pension and the specific things to consider when tax planning with a pension. So we're going to talk about a lot of things today that many people will not tell you because they may not understand the impacts of a pension throughout your retirement. You're going to be left with a higher income, which means that you're going to have to pay more in taxes in most cases. You're going to be in a higher tax bracket in retirement than when you were working. And so that's not the case with most Americans out there. Most of your peers are going to be in a lower tax bracket in retirement. So for your unique situation, we're going to break this down, especially if you've been that Midwestern millionaire that we always talk about, those who have been diligent saver and very hardworking over all these years. And so let's jump into it and talk about how you can save some money on taxes in retirement.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So if this is your first time watching this channel, my name is Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. We're based here in Columbus, Ohio, but we serve clients all across the country, and we focus in on those with pensions and $1 million or more saved. And so this is a unique crowd that I've actually written a book about called the 2% Club. I also wrote a book called The Midwestern Millionaires I just mentioned. And I also wrote a book called I Hate Taxes. And all three of these were Amazon bestsellers. And so we're going to break down this I Hate Taxes book here today specifically and talk about all these things that people with pensions need to consider. So it's going to be a very comprehensive guide to make sure you know exactly what to look for as you do your tax planning in retirement. And then if you've been watching this channel for a while, I do have to have a quick ask for you. A lot of our team members read the comments each week and they laugh at some of the comments people make, and they also get their heart warmed by some of the comments that people make. So regardless of what you say, we'd love to hear your feedback on what this channel has meant for you. What have I said that's been able to help you plan? What have I done that's been able to maybe get you to think differently about your financial planning in retirement? And so, understand also my mom watches those too. So anything good or bad, make sure we understand that that's the case. But we're going to love to hear the feedback that you give us, because that's ultimately why we built this channel, is those with pensions, $1 million or more saved. You may not be able to find specific content out there for you, but we love serving this crowd because they're typically people who are very loyal, hardworking people who have lived a life of service over all these years. If you have a pension, you've been at the same employer for a long period of time, and you're probably in most cases a public service employee at that. Firefighters, police officers, teachers, people who have really made an impact in other people's lives and have lived a life of service. And so for you, hopefully this can help you save that money throughout your retirement. So I've got a list of many things to cover here today, but let's just go right through the list here of all the things to consider. So make sure you're taking notes on this video today and you're checking off the things that you're already doing, or maybe the things you need to do differently. So one of the biggest things that we need to consider with a pension is that we will likely be in a higher tax bracket in retirement. And so this is really important to plan for, because right now, tax brackets are lower right now. Tax rates are lower. We just had the one big beautiful bill get implemented. And so that's going to leave you a lot of opportunity here in future years to take advantage of things. Now, if you haven't been making changes in the recent years, you probably have missed opportunities. The Tax Cuts and Jobs Act was implemented in 2017. That allowed for tax rates to be lower. We can't change the past though, so we can only change the future. So put that behind us, but understand that you may have missed some opportunities. So now is an important time to get ahead of that. And so with a pension, I want to emphasize that you're going to have some income streams that really combine here that make your tax planning more complex. You're going to have that pension, guaranteed income for the rest of your life. You're also going to likely force your Social Security to be taxable, and up to 85% of that could be counted as income. And so with those two income streams, we often see people are over $100,000 of guaranteed income and are already being forced out of the lower tax brackets just due to those two income streams. Now, if you have those two income streams, you likely also have some investments that are also going to be taxable when you take money out. Most people who come to us in this scenario have all of their investments in tax-deferred investments. So we're talking about 401ks, we're talking about IRAs, TSP, deferred comp, all of those employer retirement plans where you did not have to pay taxes up front. You put your $10,000 in up front and you did not have to pay taxes on that. But as you've all seen, this $10,000 has grown to $100,000. And now when you take out that $100,000, you have to have all that be counted as income on your taxes. And so you only saved on 10, but you have to pay on 100. And that's going to force you to pay more in taxes in retirement on top of that pension, on top of that Social Security. Now, you may say, I don't need my investments. I don't need to worry about that. Well, you do need to be worried about Uncle Sam then, if that's the case, because he's going to force you to start taking out money from your tax-deferred investments at age 73 or 75. And this is what's called a required minimum distribution. Those with pensions are concerned about this concept because this is when you're forced to take out about 4% from your investments on top of your pension, top of Social Security, to force you in likely higher tax brackets. And so this becomes more of an issue as you get older because that 4% increases to 5%, then 6%, then 7, 8, and it can go all the way up to 9% or more in your 90s. So not only are you required to take out more the older you get, but if your investments do what they're supposed to do, they're supposed to grow over your retirement. And so if you're growing at more than a 4% rate per year, then you're going to see that continue to go up as well. So not only is your withdrawal rate increasing, but the investment amount is also leading to you having to take large amounts from your required minimum distributions. We often see that people are going to be required to take out nearly double or more in income later in their retirement than when they're required to at 73 or 75. So if you're required to only take out $60,000 at that time, you may have to take out $120,000 later on. If you're required to take out $100,000 at that time, you may have to be required to take out $200,000 on top of your other income streams that we've been talking about. So really important to plan for because all three of these income streams that we talk about, this three-legged stool that we talk about all the time. And the reason why these three things are so important to your retirement plan is because when they all play off of each other, you're going to be left in a higher income scenario. So, most people worry about the higher tax brackets like we've talked about, but I'm also worried about the other things that could factor into that having a higher income. So not only are you going to have a higher tax bracket, but you could also be paying more for capital gains taxes. So that's really important to understand if you have a pension, is to understand the 0% capital gains tax bracket and also the 15% and 20% brackets. So the brackets of capital gains are different than ordinary income. Ordinary income is 10, 12%, 22, 24%. With capital gains, you could actually force you to pay $0 in taxes when you sell off gains in retirement if your income is low enough. And so that capital gains bracket goes up to about the same as the 12% bracket. And so you could find yourself not paying any taxes. Now, the problem is though, is if you find yourself in a higher income scenario in retirement, you may never have the opportunity to have your capital gains at 0%. Maybe you're now paying them at 15%. And this can even become valuable in retirement or maybe unvaluable for you if you don't plan correctly. When you take out these RMDs, you may not want to take it out. You may not have anything to do with the money. And so you may reinvest them into a taxable brokerage account where now you have to pay capital gains. But again, if you're having your RMD and the other income sources higher, you're causing all of those gains to be at capital gains rates, which is 15% probably in your scenario, versus 0%. So you have to understand how all of this plays together. Let's take it even a step further. Social Security taxation. Most people with pensions will force 85% of their Social Security to become taxable. If you have a moderate pension or higher, typically going to be the case. Moderate being $5,000 or more pension, be aware that your Social Security will likely be taxable or fully taxable. If you have a smaller pension, you may be able to have a chance for your Social Security to be less taxable, maybe even not taxable at all if your income can be low enough. And so understand that you're not only forcing higher tax brackets, not only forcing higher capital gains brackets, but you're also forcing more of your Social Security to be counted as income and making the rest of the scenario worse. And now another big concern of those with pensions is planning for IRMAA. And that is Medicare premiums when you're age 65. This is Part B and Part D premiums that could cost you more if you're left in a higher income scenario from that three-legged stool we've been talking about. And so a lot of our clients are going to be in positions where they have to pay more than their peers for Medicare. They're going to have to pay thousands of dollars more a year, but get the same coverage as everyone else. And so if you plan appropriately ahead of time, you could force yourself to be in a lower tax bracket in retirement. For example, if you have a Roth IRA in retirement, pulling from a Roth is going to be tax-free. That's going to lower your income to potentially be having to pay less capital gains, Social Security, RMDs, be lesser. So all that can play together here. So again, it's understanding why having a comprehensive tax plan can help with all these different areas that we're pointing out, and understand that this Medicare premium concern can become an ongoing issue if we don't address it up front. And it's because if we don't address it up front, now we may have to pay more for Medicare each year. And what I'm worried about with Medicare premiums for those with pensions is the tiers are likely going to come down, or the cost of Medicare is going to go up. What we've seen in recent years, the cost for Medicare has gone up pretty significantly at about a 7% on average rate per year for 2026. From 2025, we saw an 11% increase there. And so my concern is, what is that cost going to be moving forward? And if we're not going to control our income in retirement, right? One of the subtitle of my book, I Hate Taxes, is called Lower Your Taxes and Own Your Retirement. We have to take control of this scenario, because if we let that three-legged stool all play together, we're going to be maybe left in a lesser situation moving forward. Now, another concern to plan for with tax planning for those with pensions is planning for what's called the widow's penalty. This can also be something that plays a part in an impact with all this stuff playing together. So we know that when one spouse passes, you're going to go from married filing jointly to single tax brackets. So you are going to lose some income. You're going to keep one of the two Social Security, so that's one disadvantage. But to be in these single tax brackets means you got less standard deduction up front, and you also are going to have to pay more in taxes being in those lower tax brackets as well. And so this is something that you can start planning for ahead of time, utilizing those married filing jointly tax brackets by maybe advancing some of your investment income now to make it taxable, maybe things like a Roth conversion or taking IRA withdrawals earlier in retirement, and maybe while you're still working, if you're able to, without a penalty, and enjoying those assets now, or being able to have it grow tax-free moving forward. But the widow's penalty is a big concern, because if someone passes away early, those single tax brackets can cause a lot of added income tax over their retirement. So really important to plan for it now. But also, if your goal and you have a pension and you want to leave money behind to your loved ones, you need to be worried about what their tax rate will likely be in the future. Maybe their income is going to be lower than yours, so consider that. But they do have to take this out over 10 years now as the new rules for an IRA. And so now they may have to force more of this income to be taxable at higher rates, at unknown tax rates in the future. So that could be a reason to maybe do some advantageous planning now if your goal is to leave money behind to them when you pass away. And so one of the big opportunities that we see a lot of people taking advantage of when it comes to tax planning with pensions, probably one of the most important, is what's called a Roth conversion. So we've already hinted at this a few times here in the video today, but this is when you move money from tax-deferred 401ks, IRAs, TSPs, deferred comp, all of that money that you have not paid taxes on yet. You can move that to a Roth IRA, tax-free moving forward, if you just pay your taxes now. And I always joke with people, like, do we want to pay our taxes right now? And of course, nobody wants to pay taxes, but you can pay it now or you can pay it later. And so I always think of the Fram oil filter commercial. He says you can pay me now or you can pay me later. He said you can buy an oil filter for $4 here today, or you can pay me $200 in the future to fix your problem. You can pay me now or you can pay me later. And so similar concept with a Roth conversion. If we don't pay the taxes on it now, our investment's going to continue to grow, and we're going to have to pay the taxes at a future time with RMDs or when we take withdrawals in retirement. And so this is something that you may want to consider getting ahead of, especially knowing tax rates are lower right now, especially knowing that if you're under age 63, then you don't have to worry about increased Medicare costs if your income is higher due to a Roth conversion. Also being aware, with that Medicare premium, that age 63, it looks back 2 years. So when you're 65, it looks at when you're 63. So be aware of that calculation when you look at doing some tax planning as well in retirement. And that's why if you can get to this tax planning earlier, some of our clients like to take an early retirement because of their pension is so generous. If that's the case, make sure you're using up those lower income years earlier in retirement. Maybe you're looking at delaying your pension. Maybe you're looking at delaying Social Security. Maybe you're looking at speeding up some of those withdrawals during this lower tax rate environment. So those are all things to really consider when making this Roth conversion decision, and plus getting the compounded tax-free growth of that Roth moving forward for a longer period of time. So Roth conversions are a very valid opportunity for most people that we work with right now. Now, if you don't have a pension, you don't have $1 million or more saved, Roth conversions probably don't make as much sense. But when you are in this scenario, this 2% club where you're in a more unique scenario, this is where it starts to make more sense to do a Roth conversion. And majority of our clients, like I said, are doing this. They're not converting everything over. They're typically looking to be strategic over time. They're looking at making sure they maximize the tax brackets now and making sure they're not overpaying in taxes in retirement. So that brings up the question of what is that optimal amount to Roth convert with a pension? And it's going to be different for every single person, but I'll give you some hints of things to consider. So one thing that we consider is tax brackets. So a lot of people think, well, I want to stay in that 12% bracket because that's really low. And we agree. We always typically want to maximize a 12% bracket in most cases. But where we often run into with our clients is we really want to look to probably maximize that 24% bracket because it is a very wide bracket nowadays. Your income can be $400,000 or more, a little bit more than $400,000, and still remain in that 24% tax bracket. And also understand our tax bracket is a marginal tax rate. So you're not paying 24% on everything. You're only paying on 24% on the higher portion, and then you're paying 22% on a portion, you're paying 12% on a portion, 10% on a portion, and then you have your money up front that's actually the standard deduction eats up as tax-free. So if you have $400,000 of income, your taxable income is only about $370,000. It's actually taxable at those 10 to 24% tax brackets. So you just have to understand how all that works. But for a lot of our clients, we may want to consider going up to the 24% bracket. And I do a lot of content on this concept because a lot of people may not want to do that because it means they have to pay more in taxes upfront. But as we always remind them, do you want to pay it now or do you want to pay it later? And it's really all about paying the lowest tax rate possible over your retirement. So if you're expecting to be in that similar 22 to 24% bracket currently, then that's where we would typically advise it probably makes sense to look at the 24% bracket now, knowing tax rates could go up and knowing that these brackets aren't going to stay the same for likely ever. And so that's the things that we want to consider there. And you have to think about it. Our clients have $1 million or more saved. So if you have $2 million and if you see a 10% growth in your investments, that's $200,000 of gain. And so if you were to convert $20,000 a year to catch up for the rest of the 12% bracket, that's going to be a little dent, and you're always going to have this huge tax time bomb issue that people talk about throughout your retirement. It's only going to compound and grow and be more and more and more. Versus maybe your income right now is $200,000 and you want to convert another $200,000. Well, maybe now we can actually start to make an impact here and be able to stay ahead of this so we're not forcing our tax bracket to be significantly more from all this tax deferred growth moving forward. And so that's why using the higher brackets could make sense for you, especially early on in your retirement. Now, be aware going up to the 24% bracket, if you are 63 or older, as mentioned, you could end up paying more in Medicare costs. I hope that doesn't scare you though necessarily. It is a consideration to decide if you should or shouldn't. Sometimes we do, sometimes we don't for clients. But just to understand that you have to run the numbers on that to see if that added premium for Medicare, that added tax rate as we consider it, is that going to be worthwhile long-term considering your situation? And whenever we do Roth conversion analysis for our clients too, it's never just about today. We want to build out a long-term plan, looking at every single year and also looking 20 years in the future, being aware of the widow's penalty, being aware of leaving a legacy to the children if that's important, being aware of RMDs, Social Security when that starts. All of those are important decisions when deciding how much to Roth convert. And as we talked about, the tax rule changes play a part of this as well. When the One Big Beautiful Bill got announced, we called all of our clients and we told them we're making changes to your tax plan because we didn't think that this was going to get implemented. We thought tax rates are going to change in 2026 when the Tax Cuts and Jobs Act sunset, but now we have more years to plan, and so our plan has to change ongoing as well. So this is something that you have to adjust as time goes. It's not a set it and let it go strategy, and you also really want to run a lot of numbers here to optimize that decision. We use a lot of tax planning software with our clients. We get a lot of people that reach out to us from our YouTube channel specifically who are more DIYers. They like to do this stuff on their own, but this is one area they typically have a lot of struggle in deciding how much they should be looking to Roth convert. And a lot of times we see people, they just guess. They just, I'm going to do this because it sounds good. I'm going to do this to go up to the top bracket. But often we see that they're missing some of the other scenarios that we've discussed here in the video today. So highly recommend you work with a team when doing more of this advanced tax planning with a pension. And just understand your situation's more unique. It's not as cookie cutter as most people out there. And so you're going to be needing more of an advanced and specialized help with making sure you get all of this done the right way. And then once we figure out what we're going to be looking at doing with our, tax buckets, as we call them, how much in tax free, how much in tax deferred, right? Because we have to decide if we've got everything in tax deferred right now, do we want more of a balance between the two? But we also have to decide about tax efficient income planning in retirement. If we are going to need income above our pension and Social Security, which accounts are we going to take out from? Are we going to take out from the Roth? Or are we going to take out from the IRAs? And then it's also important to understand the tax allocation amongst those investments. If we want to be more growth oriented, maybe we want to do so in our Roth IRA, so more of that growth is tax free. The more protected type of vehicles we want to do that we're not expecting to get as much return, but maybe to be more liquid and available, let's maybe put that in our IRA so we don't have as much of a tax burden moving forward. And maybe for our taxable accounts or our brokerage accounts, if you have that, let's maybe look to have more equities in there, because now it's going to be taxed at capital gains, which is more advantageous than ordinary income rates. And so if you take your brokerage account and you put it into a protected vehicle such as a CD or treasuries or money market, you're going to force that to be at ordinary income tax brackets instead of capital gains. And so, maybe being more growth oriented in that vehicle may make sense for you and be more protected in your IRAs. And so that's something that we explore with all of our clients, especially knowing that if your taxable account has more growth over time, then your children or your spouse could get a stepped up cost basis to ensure that that is tax free to them moving forward. And something to also understand, if one of your spouses is in poor health than the other, maybe you own that brokerage account in their name so that when they pass, the spouse can actually still get a full stepped up basis. So that's going to depend on which state you're in and your situation. But that's something that we've seen be a useful planning strategy for many people. Now understand too, with these pensions, they now have more options available to them when you get ready to retire. So if you're getting ready to retire soon or you're still working, you need to understand what options you have. For example, if you take a lump sum pension versus a monthly pension, that's going to change your tax plan. And so we see a lot of times in taking the monthly pension could be a disadvantage from a tax planning scenario. So we first want to look at and see, what do the numbers run? Maybe it's a lesser tax situation to take the monthly pension, but if it provides us a much higher guaranteed income stream that maybe we couldn't beat out with a lump sum, then maybe we deal with this tax problem in order to get more benefits moving forward, right? We don't want to make a tax decision to save on taxes if it loses us money in the grand scheme of things. But what if we can, maybe it's an even, if we take the lump sum or the monthly payment, we can find vehicles in the lump sum to do better or the same, then maybe we look to take the lump sum so that we have more flexibility from a tax planning standpoint. Now we can do more Roth conversions with this money. We're not pigeonholed into taking a specific amount out throughout retirement and being forced to take this out at higher income tax rates when maybe in those years we could take out from the Roth instead. And so it allows us to be more flexible in our planning. And then you obviously have all your other pros and cons of that as well. But that's just something to consider. Now for the survivorship, a lot of clients consider, do I take the survivorship knowing that if my spouse passes away and receives that pension, now it's at single tax rates due to the widow's penalty like we talked about, and that's going to force them into a pigeonholed situation of being in a higher income tax bracket in the future versus a lump sum. We can utilize the married filing joint rates now and be able to plan for that accordingly. So understand, I'm only pointing out one part of that decision with pension options with the taxes. That's not saying that you should do that only for the taxes. It's just one consideration to think about. And then another consideration to think about when tax planning with pensions is if you're going to be charitable minded, you're likely going to get more tax savings than most people out there because of that higher tax bracket in the future. And so looking at strategies such as a qualified charitable distribution, taking money from an IRA, giving it to a charity, you can start doing that at age 70 and a half. So even if you're not 70 and a half, like most people watching this are in their 50s, 60s. So if that's you, understand this is something you can get ahead of. This is something that you can start to maybe do some more Roth conversions now, or maybe less Roth conversions now, knowing that you are going to give from your IRA in retirement. And so some people may think, I got to get everything to Roth. Well, no, that's typically not the case. We don't typically look at doing that, especially for something like charitable gifting. We want to make sure that money's available to get the tax savings from the IRA. Now, if you're still working, maybe you're under 70 and a half, looking at strategies such as a donor advice fund could be really attractive for you. This is something we do with a lot of our clients who are charitably inclined. If you're given $5,000 or $10,000 more a year, then you could be missing out on some significant tax savings by not doing this type of strategy where you're bundling your tax deductions in one year, getting the itemized deduction, looking at taking highly appreciated assets and putting them in there as well, if that's a possibility, could save you lots of money in taxes and be able to do your charitable gifting more efficiently and effectively. So a lot more that goes into that conversation, but just understand there's some really good opportunities if you are giving $5,000 or more a year to start doing more charitable gifting. And so as you can see, there is a plethora of opportunities and things to consider when tax planning with pensions. If I were to do a video of tax planning for those without pensions, it wouldn't be as comprehensive as a list. So understand that this is a huge complexity. It's why with our 5-pillar approach that we work with clients, taxes is the main pillar. It's right in the middle. It's the biggest pillar of them all because it's the foundation of everything that we do here. Every decision we make with our clients typically has a tax ramification because of that. And so whenever we need to take out investments for income, taxes are going to be a consideration. Whenever we look at, leaving money behind to our spouse or our loved ones, taxes are going to be a consideration. And so we need to understand that every decision that we make is a tax-focused decision, and to make sure that we are paying the least amount of taxes over our retirement. So hopefully this is a useful guide and reference for you as you do your tax planning, whether you're doing it on your own or whether you have a current advisor. Hopefully it's something that you can really make sure you're not missing anything with. And if you are looking for further resources, obviously you're in the right place with this channel. I'd highly encourage you to subscribe to this channel if you have that pension and you're looking for more tax advice moving forward. I'd also recommend you to request my book called I Hate Taxes. We'd be glad to send it out to you if you've been an avid viewer here and get some more resources and an understanding of how to do tax planning in this unique scenario. So if you just scan that QR code on the screen there, we'll just send it out to you for free and make sure you have that on your hands there. Just make sure you're subscribed and comment I hate taxes down below and we'll make sure to send that out to you. But again, hopefully you enjoyed this content here today and we'll see you on the next episode of Joe Knows Retirement.